Happy Friday, November 18th. Mark Milam here, your mortgage professional with Highland Mortgage. Let's get right to it. So finishing up the week a lot like we started. We saw a little bit of back and forth this week with jobless claims coming in under expectations. That's not helping the inflation picture. But then we got the Philly Manufacturing Index at its lowest level, if you strip out the pandemic, at its lowest level since 2011, forecasting a pretty gloomy outlook from manufacturers in terms of demand for goods and services. We're reading reports that Walmart and Target have exploding inventories, just not enough demand out there. All of that should go to help get inflation in line. We're not there yet, but we're on our way back down to the Fed's target rate of 2%. Going to take some time, probably at least another 6 to 12 months to get back down to the Fed's target rate, but we are on our way, and that is certainly good news for interest rates, which are enjoying a bit of a respite from the climb that we've witnessed in 2022. We've started to taper off and plateau, and will be very much data dependent now on inflation. The PCE report coming out on December the 1st, and the next CPI coming out on December the 15th.
We got to get QA on this OS because the ISP has said this UX isn't up to scratch.
Let's talk a little bit about greed. Let's talk a little bit about money.
Show me the money.
Because we witnessed in Q3 here of 2022 that Fannie Mae posted net revenue of over $2 billion. Let me flip the screen around here and let's talk about that. Fannie reported net income of $2.4 billion for the third quarter of 2022. $2.4 billion in 90 days. Quite a hefty amount of money. And we're really calling on Fannie Mae to not only eliminate loan level price adjustments, in other words, higher rates, for first-time home buyers. They've done a good job with that, but calling on Fannie Mae to suspend loan level price adjustments for all home buyers in the immediate. Affordability is getting crushed, and you need only look any further than these headlines right here. We're going to go to Financial Times. Posted this article on November the 12th that the global housing market is headed for a brutal downturn. Move over to Fortune magazine. The Dallas Fed themselves saying a bursting housing market bubble could once again plunge us into a recession if policymakers aren't careful. On over to Forbes, where we see evidence building for a painful housing recession. All of these articles are pointing back to one piece of information, and that is affordability. When you have record rates of appreciation with interest rates more than doubling in a very short amount of time, affordability gets crushed. How can the agencies help? Well, certainly Fannie Mae and Freddie Mac through the Federal Housing Finance Agency can reduce these loan level price adjustments. Yes, it's going to impact that $2.4 billion you just made in the past 90 days, but think of the impact we could have for the economy at large. And there's another piece of information to this. Let's take the focus off of Fannie and Freddie for a second and talk about FHA. So how does FHA make its money? Well, while conventional loans have private mortgage insurance, FHA has mutual mortgage insurance. This is government mortgage insurance. And we're learning that the Federal Housing Administration, FHA, released its annual report to Congress showing a capital reserve ratio for its mutual mortgage insurance fund. Hang on with me here. I know this is a little boring, but we're going somewhere.
They're just numbers and boring and black.
At 11.1%. That's an increase of over 3 percentage points from 2021. And listen, 2021, probably a pretty good year. So what does Congress mandate FHA to keep that reserve ratio at? If it's at 11.1%, what does Congress say? What's the target? Well, the target is 2%.
What?
So FHA is at 11.1 and Congress's target is 2%. Let's take a look down here at the bottom and see that the MMI fund, the Mutual Mortgage Insurance Fund, has $147 billion in capital. That's a $41 billion increase from fiscal year 2021. Holy smokes, guys. There's a lot of money getting made at a high level. And the American consumer, the American home buyer, the American homeowner who needs to refinance is getting crushed by affordability. We need our agencies, we need the powers that be to relax some pricing penalties imposed upon these homeowners, at least until interest rates start to moderate at the end of Q1, but potentially into Q2 and Q3 of 2023. All right, stepping off the soapbox. Have a wonderful weekend and a happy Thanksgiving to you next week.